Imagine a world without borrowing and lending. Sounds impossible, right? That's because it practically is. Our entire financial system thrives on debt. This is where the debt market comes into play. It is a massive marketplace where governments, companies, and even individuals can borrow and lend money. Think of it as a giant matchmaking service for borrowers and lenders. Instead of finding love, they find financial solutions. Governments need money for infrastructure projects, they issue bonds. Companies want to expand their operations, they borrow through corporate bonds. The debt market is the engine that drives economic growth. It provides capital for businesses to flourish and governments to build essential infrastructure. Without it, our economies would simply grind to a halt. The debt market is like the silent partner in every major economic activity. It's the unseen force that keeps the wheels of finance turning. Understanding this market is key to understanding how our financial world truly works. Let's break down the jargon and talk about debt instruments. Don't let the fancy term scare you. It simply refers to different ways entities borrow money. Think of them as different flavors of debt, each with its own recipe. Government bonds are like the vanilla ice cream of the debt world, simple and reliable. When you buy a government bond, you're essentially lending money to the government. In return, the government promises to pay you back with interest. This is how governments finance public projects like roads and schools. Corporate bonds, on the other hand, are a bit like investing in a new flavor, a bit more risk, but potentially higher returns. Companies issue corporate bonds to raise money for various reasons: expansion, research, or even to manage their existing debt. Then we have municipal bonds, issued by local governments and municipalities. These bonds are often used to fund local projects like parks, schools, and other public amenities. They usually offer tax advantages, making them attractive to certain investors. Finally, we have treasury bills, also known as T-bills. These are short-term debt instruments issued by the government. They usually mature in less than a year. Treasury bills are considered one of the safest investments, as they are backed by the government. The debt market isn't a solitary playground. It's a bustling marketplace with various players, each with a specific role. Think of it like a well-coordinated orchestra, each instrument contributing to the symphony of finance. First, we have the issuers, the ones who need the money and issue debt instruments. This could be the government looking to fund infrastructure projects or a company seeking capital for expansion. They are like the composers, deciding the tune of the debt. Next come the investors, the lenders who buy these debt instruments. They could be individuals, pension funds, insurance companies, or even foreign governments. Investors are like the audience, choosing which tune to invest in based on their risk appetite and return expectations. Then there are brokers, the intermediaries who connect borrowers and lenders. They are like the agents, facilitating the transaction between the two parties. Dealers, on the other hand, buy and sell securities on their own account, providing liquidity and efficiency to the market. And finally, we have regulators, the watchdogs who ensure fair play and transparency in the market. They establish rules and guidelines to prevent fraud and manipulation, ensuring the market functions smoothly. Regulators are like the conductors, ensuring everyone is playing in sync and the music is harmonious. The debt market is a complex ecosystem of these players, each one crucial for its smooth functioning. Understanding their roles and interactions is key to comprehending the dynamics of this marketplace.